Good evening. Welcome to our final live stream of 2025. Believe it or not, that time has come and we are wrapping up the year. And I wanted to do it in a very special way, featuring our very first special guest. So today we're going to talk about everything you need to prepare to buy in 2026. But first, a little bit of housekeeping as always. This is a live stream, so I am really talking to you really live right now. So please utilize the chat section. If you're on YouTube, it'll be the chat box. If you're on Facebook Live, that's going to be the comment section. Ask us questions, interact. If you have any question at any point, please feel free to drop it there. We'll be happy to answer it. And then we are so excited to also have Liz Wallace. Many of you may have met her last week, but Liz will be available in the chat box as well, answering some of those questions, providing helpful links and information. So say hello to Liz there as well. These typically last an hour. Of course, I can personally stay on as long as people have questions. I'm happy to stay on and answer them. So please don't feel rushed in any way. And don't forget to like the live stream. So if you're on YouTube, the likes and engagements, all that really helps get this channel out there and helps get this information out to new people. And please consider subscribing to the YouTube channel. We've got some really exciting stuff going on over there. You can also check out our first two guided home tours have premiered. They're available there. One is 122 Bragg Street. That is a roundhouse in Lakeview, as well as 4901 Eastern Street in Gentilly. So please do go check those out. And in the new year, we have a lot coming that I will tease to you in just a moment. And if you haven't subscribed to my weekly newsletter, I'll be happy to add you. You can either scan the QR code in the upper right hand of this video or just drop a comment with your email address and we'll be happy to get you added to that. If you are already subscribed to my weekly newsletter, you probably know the name of our special guest. She provides us with the interest rate updates, and that's always a super helpful resource to be able to track those. And speaking of things that are coming up in 2026, so we've got the Homebuyer Bootcamp coming up. That's in development. I'm super excited to get that out there. That's going to be a video and companion workbook that's going to take you through every single thing you could possibly need to know when buying a house in Louisiana. It may apply to other states as well, but that is going to be a really exciting new resource. We've got great community partnerships coming up with some cool folks who are doing really cool things here in the New Orleans area. And we also will be continuing our home brewed coffee with your advisor event. We just had our second one over the weekend at our brand new Anglin Volker shop at 2844 Magazine Street, right at the corner of Magazine and Washington. That was a great success. It was so nice to see so many people out there, repeat customers, clients who were in from out of town. Just always a really wonderful time. So stay tuned for all those updates. Please like, subscribe, follow on Instagram, blah, blah, blah. All that stuff we have now gotten out of the way. Now let's really kick things off. We all know that New Year's resolutions can be bold. You know what I mean? But if you're buying a home, if buying a home in 2026 is in your plans, then we're here tonight to help set you up to be prepared for that and to achieve what could be your first New Year's resolution that sticks, is ending up in a new house in 2026. So we have a very special guest with us tonight. As you know from the title of the video and from the promotion of the video, this special guest means a lot to me. She also means a lot to many of my clients. But that special guest is Leslie O'Neill. She's a loan officer at Movement Mortgage. She's a New Orleans native, now residing in Orange County and licensed in more states and territories than you can imagine. So if you're not necessarily looking to buy in Louisiana or you have a family member looking to buy in another state, ask if Leslie is licensed there, because she probably is, and she is going to be the best person to help you. But I've known Leslie for years now. She's been an integral part of countless of my clients' journeys. She's incredibly knowledgeable, incredibly kind, and skilled at all facets of real estate lending. So without further ado, I would like to welcome Leslie O'Neill with Movement Mortgage. Hi, Leslie.
Hi, Richard. How are you?
I'm
Hi,
good.
everybody.
How are you doing?
Doing good.
Good. Thank you so much for joining us. And how many states are you up to being licensed now?
I have, I think, 32 at this moment. But my team is licensed in all 50 states. I'm trying to get all my licenses. So any state that you need help with, like if I'm not licensed there, I got somebody on my team that can help you as well. So
okay, perfect. I mean, yeah. I wasn't lying when I said like the odds are she's probably licensed there, or her team is licensed there. So I'm going to quickly put up some of our information right here, and bear with us. This is our first time having a special guest, so this adds a new element to the technology of it all. We're going to continue to perfect this, so bear with us as we get everything rocking and rolling. But as a reminder, I do have a series of questions to ask Leslie that we're going to go through. We're going to have a bit of a discussion, but that is not to say that you are not welcome to ask additional questions. We can pause at any point and answer what you've got. So, Leslie, we chatted a little bit about this earlier this week, but I know that buying a home tends to be on a lot of people's New Year's resolutions list. Like maybe they needed those 2 years of taxes or something like that, or this is the go time, or they've been cooped up in the house with their family during the holidays and they're like, I've got to do something about this. So, what would you say, in preparing to get ready to apply with you, what type of documentation should somebody be gathering and have on hand? And then we'll talk a little bit more about pre-approval. So what documentation should people start gathering over the next few weeks?
Okay, so if you are working for a company and you get a W-2, for majority of our loans, all we require is the W-2 and the pay stubs. We wouldn't require any tax returns unless you're self-employed. If you're self-employed, we're going to ask you for the last 2 years tax returns, depending on how long you've been self-employed. If you've been self-employed for 5 years or more owning the same company, we only require 1 year of tax return. So if you had like a really great year this last year and the year before wasn't as good, we can go off of just the last year's tax return, which is, a cool guideline. And then we'll need pay stubs. If you get any type of like bonus commission income, we'll ask you for your year-end pay stubs so that we can average that over the last 2 years. If you own any other properties, we'll require copies of your mortgage statement, taxes, insurance on that property. If you rent it out, we'll need a rental agreement. We'll ask you for your bank statements to show proof of where your down payment and your closing costs are going to come from. We'll need a copy of your driver's license, and that's pretty much it to start. And then once we get your paperwork, we might, request some other information, but that's pretty much where we would start out with. And then we always look at things like if you say, for instance, the last year didn't file enough on your tax return, but that you're going to file, a lot more on this tax return. We can always look at other programs like bank statement loans to qualify you different ways than on your tax return. Or we can tell you, okay, let's get your taxes filed sooner in the beginning of the year so that we can get you ready to go, to purchase, earlier in the year instead of waiting until April 15th to file. Or we can tell you, everything looks good. Hold off. Don't file. Don't file. You don't need it. You don't need to file. We can go off of the last 2 years. So it's good to get it all together and upfront so I can review it, look at it, and see what your best plan of action is.
Absolutely. And I'm going to add here, so we have both of our contact information loaded at the bottom of the screen. So you'll see that on the ticker below now. So that sounds like a long list, but it's really not. Most of this stuff you'll probably have on hand. I know with Leslie's Teams app, or at least I'm pretty sure, people can connect their bank account with your team's application. So if you're I don't know how to do the PDF or go to the branch or something to get these statements, a lot of times people can connect their bank accounts. Is that right?
Yeah, you can connect your bank accounts on our link. You can also We can also order verifications of employment. If you don't have your W-2s and pay stubs, we can order transcripts from the IRS. If you can't get a hold of your tax returns, there's a lot of stuff that we can do internally to like make it easier for you. If you have it, great. And if not, we can help you out. So.
Yeah. So the first step is really starting with that application, because I also know that you don't have to start and complete the application in one sitting. Like you can start it, you'll see what all you'll need, and then slowly be uploading things. So if you want to start that journey and continue to add to it, you can. And Leslie and her team will also really be a great asset for you as you're trying to make sure you have everything that you need. Like they're not going to let you miss something.
Yeah, and a lot of times what I like to do with my clients is actually just have you complete the application and then let me review it and tell you what paperwork, instead of just uploading everything that's on there, because I can usually give you a shorter list. So I usually like, look through it and say, okay, I don't need that. I don't need that. Like just upload this. So that's how I like to do it up front, just so it's not you providing over amount of paperwork than you need to.
Absolutely. And Jake asked a really good question. What if you have two separate bank accounts at two separate banks? I know a lot of people have like their hometown bank and now their grown-up bank. What would you recommend in that situation?
Basically, I would only upload the account that you're going to use for the down payment and closing costs up front. If it is coming from two different accounts, and you can upload both of them into the system. But if you're, the minimal paperwork you give to an underwriter, the better. So if we don't need it, we don't need to provide it. So upfront, just use whatever account that you're using for your closing costs and your down payment. And then from there, if we need more, then I'll let you know.
Yeah, sometimes less is more. Like don't overshare in these cases, because it may raise more questions for underwriting later. So just follow the lead of your lender and they'll guide you in the right direction.
Yep.
Awesome. So speaking of this, like where you're gathering all of this paperwork, you're putting all this together, you're filling out an application, all of that is for a pre-approval. And I know people hear that word all the time. Everybody talks about the power of a pre-approval, that it's kind of your golden ticket to get into making an offer on a house. But can you tell us what exactly is a pre-approval, and what is the difference between like a pre-approval and a pre-qualification, because a lot of people will hear both of those.
Yeah. So a pre-qualification is just when you go on to the site, fill out the application, and then I run credit. And then based on what you put in there, we can tell you, okay, it looks like you qualify for X, which is not a solid approval, because we're just basing it off of, information in the system without actually reviewing the documentation. So which we can do, we can send that if you need something quick, like to get your offer in. What's really good and solid is doing a fully underwritten pre-approval. And what our company is like one of the companies that does this. And so we actually will have everything reviewed by the underwriter up front. So that's when you provide all your paperwork, your pay stubs, W-2s, tax returns, bank statements. We will actually review it, submit it to underwriting, have the underwriter review it up front, and then let us know if there's any issues or if we're all good, good to go. And then we can let you know from there, like what your max qualification is. And then we can also, go down from there and see what you're comfortable with, payment wise. But it's really good and solid to do a fully underwritten pre-approval up front, because it helps me and Richard sell you to the listing agent. So basically, like if Richard submits an offer, I can call the listing agent and let them know, like they're solid, they've already been through underwriting, like there's going to be no hiccups on this transaction, and we can both as a team work together to like get your offer accepted. So it's good to like do things in advance so that you have a little bit more time to do that work, and then you have a more solid offer. And then also that you don't have to worry that you're going to have an issue when you go into contract, so that you're solid at this amount.
Yeah, and that's one of the great reasons that we tell people it's never too early to start talking to us. Like if you have the idea, you're thinking maybe it's not a New Year's resolution of yours to buy a house in 2026, but you're entertaining the idea of it. It's great to go ahead and start connecting with your team. That's going to be your lender, your realtor, even insurance people. That's really helpful. So we've got great recommendations for insurance agents, but it's never too early to do that, because let's say too, once you have the idea to do something, you really start to go after it. So you can go ahead and get pre-approved, fully underwritten pre-approval with Leslie, and then know that you're good to go at the time that feels right for you. The other thing that's really great about that is the market may be slower right now, but we're still running into multiple offer situations. So if you are trying to beat out another offer and not raise your price too much and just throw money style spaghetti at the wall, then it's great that your lender can advocate on your behalf, call them and say they're fully underwritten. And hey, even at that point, you could close quicker if you need to.
Yeah, so that's our big specialty, is we can close pretty quick. So we've done that a lot with Richard and I, where we go in and we offer 18-day closings, or sometimes even 15-day closings, like to have you stand out in front of the other offer that's on the table. So that's one thing great about doing the upfront underwriting approval, is that it gives you like a quick edge, that you can get it done really fast and get it closed quickly. And our underwriting turn times are like 24 to 48 hours. So we can do it. To get you the pre-approval, it's still going to be quick for you.
Yeah. And yeah, people can get their pre-approvals back if you start first thing in the morning. I've seen them come back by that evening. So it can be a quick process. It's never too early to start, but it can be a quick process to go through that and get that pre-approval letter. But that's not to say to wait until the last minute. That's crazy. So don't do that.
Yeah.
Liz asks a fantastic question. How long is a pre-approval letter, quote, good for?
So on majority of the loans, your credit report is good for 120 days. So once we run your credit, we don't have to rerun it for another 120 days for that pre-approval letter. Documentation, it's depending on when you go into contract on it, you might have to update your pay stubs and bank statements depending on how many months it's been. But yeah, it's good for about 120 days.
So that gives you a whole 4 months. I mean, I think that's pretty amazing that if you started today, your pre-approval would be good until mid-March. So you would have plenty of time to be searching. And can you explain a little bit about, like, there's the option to kind of refresh it in a way. Like once you've hit that 120 days, do you have to start entirely over?
So what I always recommend is not just rerunning your credit every 120 days. So because you don't want to get the hard inquiries on it multiple times. But once you actually find a property that you really like, then we can just run it right away and get you that updated letter, so that you're not running it every 120 days. And also we have an option for a soft pull on your credit report as well. So we can do that up front. So, it isn't a hard inquiry on your credit, that we're just doing a soft pull and, basing it off of, the credit information on that. So that is another option as well.
And what is that difference between a hard pull and a soft pull?
Well, a hard pull inquiry is, pulling all 3 bureaus, and it's, hitting your credit as an actual inquiry. A soft pull is just pulling one, you're giving one score, but it's not like hitting your credit as a hard inquiry on it, meaning like affecting your credit score. So sometimes it may not pull all the liabilities. That's why I kind of review it with the borrower to make sure like it is, everything's on there, but it's not going to give me all 3 scores. It'll give me 1 score. So we base it off of that in the beginning. But then once you actually find a place that you really like we can do the hard pull right away. So.
Okay, good deal. I know that I still get confused on that sometimes. I'm like, okay, you get like X number of hard pulls a year versus soft pulls. It gets confusing. So before you ever run your credit, reach out to your lender first. I think that's really important. Yes. EV Nola Real Estate, who is Scott, thank you for joining us tonight, or it's usually Scott. Scott asks, can too many soft pulls have a negative impact on your credit score? We know too many hard pulls can, but what about those soft pulls?
No, a soft pull wouldn't affect your credit score.
Okay, so you could do as many soft pulls. Like, I know some people
would need to. I mean, it would be like the same thing, good for 120 days, and then we could, redo it when needed.
Okay. And I know that a lot of people, they want to like rate shop and they want to explore, they want to talk to as many different lenders, and they get maybe cold feet, or they're a little reticent to commit to someone with the fluctuations in the mortgage market. So how do you recommend people who want to shop or get a rate, or they say, I just want to work with the person who has the lowest rate? What do you say to that type of buyer, and why is that not necessarily always the best path?
I mean, you do always you can shop, and you have a 30-day window from the time like that one lender runs your credit to run it with other lenders that for mortgage, without it affecting your credit score. But it's not only about interest rate, it's about service, and it's about, getting that deal done in a timely manner, and being able to get in touch with your loan officer, when needed. For me, I work weekends, I work evenings, I'm early in the morning, Richard, can contact me at anytime really to have me do stuff. And if I'm not at my computer, I can get him a pre-approval right when I get back, but he knows, when he'll have it. So it's just, there's a difference between working with a lender that's available when you are out shopping, which is mostly, on the weekends or in evenings after work, and to be available to help you with a pre-approval at that time and not have to wait till Monday morning at 9:00. So and then if you want to run payments or do anything like that, to have somebody who's available.
Yeah, there's another thing that's kind of buried in there, and then I do have to give some accolades after that. But the other thing is, and we've talked about this in past live streams, is that a lot of these big box online lenders, insert names here, but you see their ads and their commercials, they'll advertise these like crazy low rates. But once you get into it, then they have quietly baked in fees in other places. So don't take the rate at face value. Look at the summary of fees and costs that may be kind of baked in there and sometimes hidden in there.
Yeah, I just had one today that a client emailed to me, and they had it was a quarter better interest rate than I quoted with no extra cost. But I was like, and they sent it to me, and it was charging them $7,000 to save them like just a little bit on their payment. I'm like, that would take you years to recoup that, cost that you would pay up front. So you have to really look at the estimates and not just the rate, and see what the costs involved for that.
Absolutely. And feel free to share that with your lender. Like, there are times where my clients may feel that they have a better deal with someone else or one of those big box online stores, but I know, and this is the place that I can give those kudos, is that like it is completely invaluable to have your lender available in what I call quote unquote like real estate hours. That's going to be nights, that's going to be weekends. Leslie has worked in Mexico, like on vacations, like it's crazy. We try not to let her do that, but she does it. And, despite being 2 hours behind us in New Orleans, I can text Les. I don't know when she sleeps. I just really don't. And she's also a mom and wife and friend and all of that stuff too. But it is so helpful. I always tell people to find a lender who's going to give you their cell phone number. Don't be calling through a phone tree and all that kind of thing. But yeah, with that, take those fee sheets. It's called a fee sheet. It breaks down everything that you're going to pay, and share that with the lender who you feel can look out for your best interests and who you also kind of vibe with. Like it's kind of like finding a good realtor. You want to make sure you mesh with that person because you are going to be working very closely and kind of sharing some, intimate details. Finances are scary and they're intimate, and you need to find someone you can trust.
And also, rates change daily. So you could have gotten an estimate from one lender on Tuesday and then got another estimate from another lender on Thursday, and the rates dropped, and so you just always want to, compare, because it's day to day what's happening with the, mortgage interest rates up and down. So you just want to compare apples to apples, like that day, that you're getting that quote, to make sure that you're on the same page with both, lenders.
Absolutely. And a huge red flag is if the lender is not willing to sit down with you and compare those two. Probably not a good idea to work with them. If they're not willing to like pull back the curtain on it, kind of a red flag.
Yeah.
So Jake had a good question, and I'm going to note that question because we're going to talk about that in 2026. So Jake, I'm going to get back to your question, but just so everybody knows, Jake's question was who decides what the interest rate is. So we are going to talk about what both of us are seeing in interest rates, what the hubbub and the chatter is about interest rates moving into 2026. So Jake, thank you for that question, and we are going to make sure that we answer that here in just a little bit. Okay, New Orleans in general is a major gig worker city. Like it's very tourism heavy. It's very independent contractor heavy. I myself am an independent contractor as a real estate advisor. But what would you recommend for someone who's self-employed? What type of programs is it? Is it a lot harder to get a mortgage? How would you approach someone who may be self-employed?
If you're self-employed, I mean, you can qualify like on a regular loan, regular conventional loan by using your tax returns. And we basically review them on your adjusted gross income. So it's not, like when you're a W-2, we go off of your gross, but when you're self-employed, it's your net income. But we do have, and a lot of people that are self-employed write off a lot of their income. So, if you can't qualify that way with your tax returns, we have other options. So we have a bank statement loan, and the bank statement loan is where we take the last 12 months of your business bank statements, or if you put all your business income in your personal bank statements, we can use that as well. And we take an average of what you deposit in the last 12 months. And usually they take 50% of those deposits and use that as an income to qualify. So we have that option for self-employed. We also have an asset loan, which is a pretty cool one that we just came out with, that we take the borrower's assets and then we can divide it over 60 months and we come up with an income based off your assets. The only thing is that you can't use those assets that we're using to qualify for your down payment. So you have to have separate for your down payment from the assets that we're using to qualify. So that's another way. If if somebody has like a big, an account, stocks account or anything like that, that we can use that as to help qualifying you on an asset loan. And then we have other programs too, like for investors, if you want to do what's called a DSCR loan. So basically we don't even look at your tax returns or anything, your bank statement, we don't look at your bank statements for income, just for your down payment. But that loan is really cool. We just qualify you off the rent of the property. So if your rent covers your taxes, insurance, mortgage payment, then you can, qualify for that loan if you have the correct down payment. So there is other options if you aren't able to qualify the regular conventional way.
Do you have to be a seasoned investor who's done this before in order to qualify for DSCR, or could someone who may want to their first home could be a fourplex? It could be something like that. Is it required that you've done investment work before to qualify for DSCR?
They usually want you to own a home because people were using it to do buy a primary residence, their primary residence. Yeah. So they usually want you to have at least a home, but we do have some programs that don't require that. It's usually more down payment though.
Yeah, and a little bit of background, when Leslie references these programs, you're talking about a lot of traditional banks, the Chases, the Hancock Whitneys. There are a lot of these big banks that aren't able to offer the same amount and variety of programs that people like Movement Mortgage are able to offer, because Movement may have private investors who back them. I know that we have done this before. I can't remember exactly which house or client it was, where essentially this was a very unique situation. It might have been a very high priced property or something like that, but your team was able to shop it around to investors. Would someone be willing to take on, essentially invest in this person in a way? So think of that when you're looking at a lender. If you may have a particularly unique situation, someone like Leslie at Movement Mortgage may be the best because they have a large variety of programs and products, loan products that you could qualify for. So yes, I love everything that they can offer. Speaking of, we'll use this moment to plug. Speaking of loan products, I know that Movement does have a variety of different loan products and special features. One of which is Movement Boost. Would you mind sharing a little bit about products that y'all offer that people may not have heard of that they could take advantage of in 2026?
Yes. So Movement Boost is our own specific program, and it is a really cool 100% financing programs, meaning you don't have to have any down payment. And you can also even, go in with the offer and ask the seller for closing costs. I have like a couple closing right now that the borrower is bringing nothing in at closing and even getting their deposit back because they got a seller credit. But how it works is it's an FHA loan, which is a government loan on your first mortgage. And then we give you a second mortgage behind it to cover the down payment. So on an FHA loan, your minimal down payment is 3.5%. So we have a second that will cover the 3.5%. And then we also have another one that will go up to 5%. So you can so it'll help you with your closing costs. So we can either do the 3.5% second mortgage or the 5% second mortgage. So it doesn't have to be a first-time home buyer, which is really good. It can be a 2-unit property, 1 or 2 unit property. And so it doesn't have an income limit. So a lot of the down payment assistance programs that are around, there's an income limit. It has to be a first-time home buyer. So this program it doesn't have any of that, and you can still get 100% financing. So it's a really, really good program if you don't have a down payment, to help you with that.
Yeah, there are a lot of people go towards the buying a double or a duplex in New Orleans. One, because we have so many of them available, but that's also a great way to sort of fast track your wealth building through real estate. So a program like that, where you may not have a ton of liquid cash on hand to put towards the down payment, a program, apparently I'm jolly old England, a program where similar to Movement Boost could be a great way to help people, kind of reduce that barrier of entry into the dream of home ownership. So I love that is available. Okay,
yeah,
go ahead.
I was going to say, and then they also have, programs like for specific parishes that they have as well. So like in Jefferson Parish, they have a grant program that's really cool. It gives you up to 4% in a second mortgage. So that is something that we could look into. There is an income limit on it, which I think is about $86,000 right now on it. And it's for everyone who's going to live in the household. So we'd have to look at, whoever's going to live in the household, but it's, free money. Like you're not paying that, you're not paying a mortgage like you would on the Movement Boost product, paying a second mortgage. But so when we do your application, like I'll look at all those different options. And even in Orleans Parish, they have like the Louisiana Housing Corporation, which is like for the state. So it's any parish that also offers, down payment assistance of 4% on a grant. So I would definitely look at all the options for you and make sure that, you're in the best product for you. But know that we also have our own specific program if you need 100% financing and there's no, you can't fit into that category for the grant.
I love that. And I know that Leslie and I will never let you leave money on the table. Like if there is an opportunity to find cost savings or find the best program, we'll definitely make sure that we can match you with the thing that is going to save you the most money and be the most advantageous. Scott asked, this is in regards to Movement Boost. Are there any geographic or price limitations on Movement Boost?
It's FHA loan limit. So you can only go up to the loan limit in that parish for FHA. And what was the other question? That was the limitation.
Any geographic or price limitations?
No geographic. Any parish, any state, actually, yeah, you can do it. But it can only go up to the FHA loan limit.
I'm doing a search on the other side. For a single unit property, the FHA in Orleans Parish, this may vary by parish, but in Orleans, the FHA loan limit is $524,000 for a 1-unit property, $671,000 for a 2-unit property, $811,000 for a 3-unit property, and you cannot do more than 4 units in FHA, and that maxes out just over $1 million at $1,008,000. So you're probably going to be covered by that. You're looking at some pretty high prices for our market if you're looking to exceed that. So that's good information to know. All right, there's the big hairy scary of it all, and this is credit scores. We talked a little bit about it earlier. We talked about pulling your credit scores. People get very anxious talking about credit scores, but let's demystify that. Like, let's take the taboo off of it. Let's talk about credit scores. So I would ask, if somebody is, well, first, let's start with what are the minimum credit scores for the different programs? So like FHA is for first-time home buyers, VA is for veterans, there's conventional, all these other products. What are those minimum credit scores for the various programs?
And so FHA and VA, we can go down to 580 credit score. And so that's really good that we can go down to under 600. So if you are under, 620 credit score, that's the options that we would give you. If you're a veteran, we would go VA. FHA would be the option we would want to go with if you're under 620, because a conventional loan is 620 and above. So, you still, people think that like if they're in the 600s, they're not in excellent credit range and they can't get a house, but you can. Like you can get a house, and we can go with the lower credit scores as well. And with an FHA program, that's not that big of a hit to the interest rate for your credit scores. So like, for instance, excellent credit on a conventional is 780 and above. And then there's a hit to the interest rate every 20 points. So if you're at 760 to 779, there's a slight hit to the rate. If you're at, 740, 759, there's a slight, and it goes down from that to 620. But FHA doesn't have as big as hits to the interest rate for that. So when I would take your app, I would look at it and price it out and see what would be a better rate for you and payment depending on where your credit score is and what program would be better. So we review all the different options based on your scenario. So interest rates are given by certain criteria. It's based on your credit score. It's based on how much money you're putting down, and the type of property that you're buying, and then the program that you're using. So when it comes to us looking at all of that, then I give you your best option, your best payment option as well.
Okay. And to sum that up a little bit is essentially the higher your credit score is, the lower risk that they see you to be. So the higher your credit score is, theoretically, the lower your interest rate will be. So that's what Leslie's talking to, is there is an inverse relationship between those two. But if you were to go to FHA, there's a smaller discrepancy between those. So it's not going to be as punitive as it would be with a conventional loan.
Correct.
If I think that's right.
Yes.
So,
perfect.
Thank you. So also with that, so let's say we're taking stock. We're trying to see how ready we feel going into 2026 to buy. What if my credit score isn't where I need it to be, or if, for instance, I'm on the cusp, I could be really close to getting a really good score. How can people, and I know that your team is really good about this with credit journeys and credit improvement journeys, but how can people either rescore or use programs or support through you to improve their score and ideally improve it faster? Yeah.
So once I run your credit, we'll take a look at it, and if we think it's not at the score we need for that program, then there's different ways that we can get it increase quickly. So we have a thing called a lending hand that we submit into our credit company, and they come back to us and tell us if they pay this credit card down to this, if they take care of this collection, if they can, sometimes, you'll even have a late on your credit. It wasn't correct, that you didn't even know about. If they can get a letter removing that, which it happens a lot. And then we can get letters showing your new balance on your credit card. And then if there's any discrepancy, we can get a letter from that credit company showing that there was a discrepancy. We submit it into the bureaus, and I just did one the other day. I got it back in 3 days. So it's pretty quick. So there's a way. And then also, you know, maybe your credit score is good enough to just qualify, but we want to get you the best rate. So I'm like, all you have to do is pay off this one card to this, and your credit score is going to jump up to X. And if it does that, then you'll get this rate instead of this rate. So sometimes like we just do it like to help you out on your interest rate, as well as like helping you out to qualify, you know. So there's in the company that we work with, they're really quick on reviewing the report, and they give you the least amount that you'd have to pay out of pocket to get to the score that we desire. So they give you like the best option to get to that credit score quick.
I think that and I've had a number of clients do that successfully with you, and I love that makes goal setting and planning around debt reduction so much more manageable. You know, people just say pay down your debts, and it's like, I wouldn't even know where to start. Do I pay this? Sometimes you hear of like, I paid off this credit card, my score went down. So using a program and connecting with a lender like Leslie and her team can offer is a great way to not just throw money at the problem that may cause a bigger problem later on. So they can do all these different scenarios. Say if you tweak things specifically with realistic numbers, that gives you something, a true goal that you can plan and prepare for. So I think that's a great way. I always say that folks are sort of like, I don't know, I think of Leslie as like a de facto, don't tell anyone this because I think there's some laws around it, but like financial advisor in a way, like their financial advisor light in a way is your lender.
Yeah. I mean, we want to look at all aspects and make sure that you're making the right decision. It's the biggest purchase of your, life. So we just want to make sure you're getting the best deal and getting in the best product and the best interest rate that you can get. And then, figure out ways to do that.
Absolutely. And I had a client text me a question, so I'm going to read that. And then Jeff, we're going to get to your question after that. So the text I got says, is it possible to ask how, yes, it is possible. I'm asking it right now. So how do qualifications work if you lost a job within the past year, but say now you have an income that would qualify? Can that be a factor? So how does job loss and then new income play into your ability to qualify?
So if it was a job that you previously had that was like a W-2 job, and now you're going into a new W-2 job in the same line of work, then that's no issue. Like it should be fine to qualify off of the new income. If for some reason you go from a full-time job to a part-time job, then that can be an issue on qualifying. So if you are going to make any job changes, and you want to apply for a loan, it's best to go into the full-time, because that is where you can qualify right away.
And in the same line of work.
Yeah, and same line of work. But I mean, I've even had where people were in one line of work and then they got it and they were in like a, not similar, but they were in a W-2 job that was a salary or a, full-time 40 hours. And we accepted it because it's, a set amount that they're going to make, and they have a job history. So it's, even if you have on a conventional loan, if you have a gap in employment we look at the last 2 years of your employment. If you have a gap in employment, there's usually just an explanation you need to explain. Like, I was off having a baby, or I had to take care of my mom who was sick. And, then they can just look at that history. And as long as it's, stable and you're making that new salary now, there's ways around it. So
yeah, and this is one of the reasons I just love having you, other lenders in our community who are real people, because there is such a human component to lending and the mortgage network and all of that. It's a lot more human than people may realize. I know that it can be very scary when you go to approach this or start lifting the hood on your finances. But just like Leslie was talking about all these different scenarios, they will ask you questions and you can explain. It's not just, do you make this money and do you have this credit score? And if the answers are no to those things, there are still opportunities for you, but you need to connect with a preferably local lender, which I consider Leslie a local lender because she knows New Orleans better than I do, and she grew up here. So,
and I'm there once a month.
All the time, all the time.
I can't miss out on the fun.
Yes. So she keeps one foot in both locations at all times.
Yes.
So we'll pop over to Jeff's question, and then we're going to talk a little bit about interest rates and where we see things going. But Jeff asks, does medical debt bring your score down significantly?
Well, recently they've changed that where it's not. So it shouldn't. I mean, I don't think it does anymore like it used to. So it can't, if something goes into collections, I'm not like an expert on that, but it just recently changed where it shouldn't be affecting your score like it did. If it was in collections before, yes, it would have a big effect on your credit, but now it's not affecting it as much with medical.
And if I remember correctly, so we've talked about this at different first-time homebuyer programs that we've done together, but that there are some ways that if something does go into collection, people face difficult things all the time. You may illness, death in the family, loss of work, something like that, and things may go to collections. Are there ways, and if I remember correctly, there are, that you can either make an agreement to pay a certain balance of that, like it's different on each one, but if you satisfy that debt, is there a way that it doesn't have to linger over you for 7 years?
You would have to negotiate that with the collecting company, which I have like a really good credit person that we work with that does credit repair, and he can help with that, where they negotiate an amount with you and then ask them to remove it if you pay this amount. So because a lot of times if you just do it yourself, they're not going to actually remove that collection and it will linger on your credit report. But if you want to get things removed, we have people that you can, work with to help get those things removed to get your score up.
And if there's anything I know about real estate, everything can be negotiated. Like everything. I mean,
they want money. They're already in collection, so it's like they're likely going to be willing to work with you. Hopefully,
that's right.
Yeah.
And so okay, here's another big one that everybody's asking: interest rates. Good Lord, is it in the news every single day? I get an email from Leslie literally every single day updating me on interest rates. So where do you see interest rates headed? Let me go ahead and give the disclaimer for this so that Leslie doesn't have to do it. No one has a crystal ball. We can infer based on certain information, and that's what we're about to do. But if our thoughts and projections don't come to fruition, don't come at us. Like we wish we would know. But back to it, Leslie, what do you see happening with interest rates in 2026?
I think there is going to be a gradual decline. I don't think there's going to be a big drop in interest rates, but I do think there's going to be a gradual decline. That's why I think, don't wait for interest rates to drop to buy, because, they've been saying that the last year and that, rates are going to come down. And yes, they've come down a little bit, but it's not like what we were seeing in 2020, in the 2s and 3s. So if you are, it's always good to get in the game, get in and buy, and then you can always refinance later. So, there's always an option. If the rates do drop, you can, lower your payment. So it's, I do, and even the bigger, like Redfin, like they're all predicting that there's going to be a gradual decline. It's not going to be like a big drop in rate this year.
Yeah, and I the way that I've been describing it is similar to how I've described the insurance market in Louisiana, is I see a softening. Like it's not going off a cliff. It's not anything like that. It's a softening. It's not necessarily going to just drop into the 4s all of a sudden. This is a gradual decrease that we expect to see. And what I always I'll say that again.
I was just gonna say what's kind of crazy about rates is that like when there's like bad news, the rates go lower. So like if the unemployment rates are higher, interest rates are lower. So it's kind of a weird, thing. But when there's more like bad news, then we'll see a decline.
Yeah.
in interest rates. So,
which is there to spur spending activity. Like the cheaper money is to acquire, the more they expect people to spend it. So that's where that philosophy comes from. But I always tell clients the right time to buy is when you find a home that you love and it is and it fits your budget. Like don't buy now. A lot of people got into this with Airbnb. Don't even get me started on that in New Orleans. But the right time to buy is when you find a home that you love and you can afford it. Don't take on a monthly payment being like, it's going to be super, super tight, but then in 6 months, that rate's going to drop. No, you need to make sure that this rate and even, or this monthly payment is comfortable to you. And I would also recommend including a buffer on that. Have your max that you're willing to spend and make sure you're doing so below that. Just because you qualify for $500,000 doesn't mean you should spend $500,000.
and then also like Richard and I, this past few years when rates have been, higher, he's negotiated a lot of deals with sellers for his buyers to help get their rate down for 2 years. So we have a program called a 2-1 buy down. So for instance, if the rate's at 6.5 today, you pay 4.5 your first year, 5.5 your second year, and then you're fixed at 6.5 at the term of the loan. Well, the seller gives you a credit at closing to pay for the difference in the payments for those 2 years, from the 4.5 rate to 6.5 the first year, and then from 5.5 to 6.5 rate the second year. So it's a way that we've been doing it, to help out to get a lower payment while we're waiting for rates to come down, so you can hopefully refinance before you ever got to the 6.5%. So that's another option that we look at. And also you're qualifying at the 6.5% rate. So it's not like you can't afford that payment, because that's what we're qualifying you off of. It's just giving you, some breathing room and help for the first 2 years, and then the seller's paying for it. So that's another option to help get you a lower payment.
And I love that you brought that up, because Leslie actually did that for my brother and sister-in-law. So they bought a house 2 years ago on a 2-1 buy down FHA. We made sure that the highest their mortgage rate would be is where they were comfortable. So they're just wrapping up their 2-1 buy down, and it's going to that originally planned amount. But they were able to save that money over the first 2 years, and now they're back where it would have originally been if they hadn't had a buy down. So we made sure that final payment amount was what they were comfortable with. So it's just the first 2 years were a bit of lagniappe, just something extra.
And a lot of times people, as they move on in their career, the next year they may get a bonus, they may get, an increase in salary, they might get married and have somebody. So it's like, it's giving you a couple years to get your finances in order as well, that you're more comfortable if it got to that point. So
absolutely. And then because it is always a promise I make to myself to never miss a question, going back to Jake's question, I know this is complicated. So everybody take a deep breath with us. But Jake asks, who decides what the interest rate is? Where does this come from? Like, are there tiny mice pulling gears behind a curtain? What's going on?
Well, it's all based on like the 10-year treasury, how they, decipher rates. And then there's like a lender spread on top of it. So that's why you see different rates between different companies, depending on what their spread is on that interest rate. So that's why, it's always good to shop and see, who has the best interest rate out there. And so, we follow it very, like I am on a site called NBS Highway. If you ever want to follow interest rates, follow that. It tells you every day what, if they suggest that you float, or if they suggest that you lock in an interest rate, they're following the market to a T. They know exactly like what conversations are going on, and they tell you lock it in, rates are going to go up. So we follow it very, very closely. But yeah, that's what they're based off of.
And I just pulled the URL for that. That's NBS Highway. So I dropped that in the chat. So if you want to check that out, that is available in the chat and in the comments. So it's really, at the end of the day, it's the federal government. It's like the stock market, essentially. It's based on leading indicators of, you mentioned earlier, unemployment rate, inflation, just kind of the bullishness or bearishness of the market in general, right?
Mm-hmm.
Yeah.
Yep. And they're even talking about like the federal government buying into the mortgage-backed securities, which if they do that, then the rates will come down. So we'll see
There's
what happens.
a lot to go on, but great ways to stay, reach out to Leslie, keep up with my newsletter. We will be keeping you up to date with this information. It changes every single day, but we try to stay on top of it. So be in touch with us as much as you can.
Yes.
Liz asked, of course. And Liz asked a good question. And I would love for you, if the program is still available, to talk a little bit about how you can use the rate buy down and the refi, that balance. But Liz asks, what does the refinancing process look like?
So if you're going FHA to FHA, we have a FHA streamline, where it's actually like, we don't even need your credit. We don't even need your income information. It's just basically we're going from whatever your rate was then to whatever the rate is now. It's a streamlined process. We also have that for VA. It's called a VA IRRL, interest rate reduction loan. So it's the same thing. We don't need your income. We don't need your credit score. It's just reducing your interest rate. But conventional loans, if you want to refinance a conventional loan, we will have to, run your credit again. You may or may not have to get another appraisal, depending if you get an appraisal waiver when we get it through underwriting. But you do have to qualify again. So you'll have to, get your documentation in, your tax returns, W-2s, payslip, whatever, you're required to send in. So it is another qualifying loan. But FHA and VA, you don't have to do that.
Nice. And about how long does that process take?
We're closing refis in about 21 days.
Okay. So about 3 weeks start to finish on that.
Mm-hmm. So that's just one thing you want to, make sure you keep up your credit score, make sure it's, you're keeping all your bills, on time. So when you do go to refinance it, you're in the same situation.
Yeah. And we've got about 5-ish minutes left with Leslie. Of course, I can stay on as long as people have questions. But if you have any last minute questions for Leslie, go ahead and drop those in the chat or text me. That seems to be working well. I learned from the very first live chat not to silence my phone during these, so now I can keep up there too. So feel free to text me or comment your last questions for Leslie, and then I'll be able to stay on as well. And then I think kind of the last thing that we have on our list that we prepared to talk about is some people may have pretty relatively new credit, but you hear a lot about cosigners. So what is that? What implication does that have for the cosigner? Who can be a cosigner? Tell us a little bit about cosigners in general.
So a cosigner is only like a family member, or they call it close friend you can have as well. So it's somebody that if you can't qualify on your own, you can get what's called a non-occupied cosigner, meaning that they don't live in the house, they're not moving in the house with you, they're just helping you qualify for the loan. So it'd be your primary residence. So you still get all the benefits of like having the lower interest rate for buying as a primary residence. You get the benefit of having the lower down payment for, being your primary residence, but it's somebody just helping you qualify. And so basically we would need all the same information as from them. We need their application, their income, documentation, and credit scores and everything in order, to qualify them on the loan. And we have to look at their debts and everything else to make sure that their income exceeds, whatever debts they have to be able to help you, qualify. And so the thing with them, what they would have is it would be on their credit report. So if you missed a payment, then it would go on their credit report as a delinquency on their credit report. So that's just something that they would have to consider while, doing that with you on the application. But it is a way that we can help you qualify without will still giving you the benefits of buying as a primary residence. You can have somebody co-sign with you.
Nice. And is there a way for the cosigner to ever kind of offload that financial liability? Like could you buy them out? Is there a process for having the cosigner come off of it?
Yeah, so you can do that in a refinance. So a lot of people will do that, like say they're, self-employed and they didn't show a lot of income last year, but they know they're gonna kill it the next year and show all kinds of income. They may have a cosigner, co-sign them for that 1 year and then refinance them out of that loan the following year. Or, if you end up, getting a raise or a bonus or something, you can qualify yourself, you can take them off whenever you refi. But that's the only way you can get them off, is to actually refinance them off of the mortgage.
Okay. And Sierra asks, does having a cosigner disqualify you from the Movement Boost program?
No, you can do that. You can do that.
Okay.
You can have a non-occupied cosigner.
Love that. Good deal. All right. Well, Leslie, thank you so much for being here. It is always just, you and I can talk on the phone for hours and hours and hours, and gab in person for that long about all of these things. Is there any last bit of advice or thought or tip that you would like to give our viewers as we head into 2026?
I just think if you're, on the fence or you're ready to move forward, like just give us a call and let us take a look at everything and, see what we can do. Don't be nervous about it. We make it easy. We're easy to talk to. You can let us know like what your worries are, but just, have us take a look at it, see what we can do. And, we'll make sure that you get the best deal possible. But yeah, don't be scared about it. And I think it's best to get in, because it's better than paying rent. Like when you pay rent, you don't get a write-off, you're not gaining any equity on a property. So, in New Orleans, it's great too. They have a lot of duplexes. So you could even, buy as a primary residence on one side and have a renter on the other side to help pay half your mortgage. So it's, there's a lot of options out there, so that you can get into a comfortable payment and own.
Absolutely. And people can get in contact with you. We have your email address, phone number. Follow Leslie on Instagram at Lender Leslie. But all of her information is in the chat. Liz just dropped that over there in the chat. And it's also in the YouTube and Facebook description boxes. And if you, for some reason, can't find it or you lose it or whatever that is, I know exactly how. I've got the red phone to call Leslie to get the direct line. But with that, thank you so much, Leslie. Happy holidays.
Thank you.
It's so nice to have you. So we will talk very soon, and I'm sure everyone will be seeing more of Leslie in the coming months. Thank you, Leslie.
Thank you for having me. Happy holidays.
Happy holidays. All right, everybody. Thank you so much for joining for the last live stream of 2025. Thank you for all your wonderful questions. Of course, special shout out to Leslie. It's so nice to have Leslie join us for this. In the new year, we're going to be having more experts from their various fields. We're going to have insurance agents and brokers. We're going to have people from the inspection world. We're going to have people from a little bit of everything. So do stay tuned. Please like this live stream. Please subscribe. We're going to be doing so much over on YouTube in the new year. And if you do ever have any questions, again, my phone number is 504-617-5184. It's also running across the ticker at the bottom of the screen. My email address is richard.aber@evrealestate.com. You can visit my website where you can book a private one-on-one consultation. That's 30 minutes to an hour, however long you would like, as a phone call, as a video chat. You can come meet me in our brand new, beautifully renovated shop on Magazine Street at 2024 Magazine Street. And it can also just be a phone call, whatever you'd like. Doesn't have to have a total topic, and we can chat about whatever you would like. So with that, As always, it means so much to me that you've joined tonight and shared your questions and shared your curiosity. As I always say, I believe in empowerment through education. So all of this will always be free. Any resource that I ever mention or I ever create or ever provide will always be at no cost to anyone. If you do have anyone who is interested in exploring, buying, or selling, or anything in real estate, it does mean the world to have your referral business. So please don't hesitate to throw this hat in the ring. I would really appreciate that. So without further ado, I want to wish you the most joyful holiday season from all of us at Anglin Volkers New Orleans and Leslie and her team at Movement Mortgage. I'm just wishing you the happiest of holidays, a happy and safe new year. If you're traveling, please do be careful. And I will see you in 2026. It's almost here. Have a great night.